take a look at your economic calendar, and you can use Econo Day, you can use Forex Factory, um, whichever one you prefer, really. You'll notice there's an absence of any kind of significant news drivers today, but Tuesday we have CPI, Wednesday it's PPI and retail sales, and then Thursday's a heavy hitter. We have Philly Fed, manufacturing index, and employment claims. So Tuesday and Wednesday are going to be wild. That's the face rippers, the, the market, literally just well, it's impossible to trade them. Okay, without it being a gambling. So it's Monday ahead of all that. So I don't have a whole lot of expectations in terms of big movement. They're going to reserve that for Tuesday, Wednesday, and Thursday. So how do you trade those environments? Or let me rephrase that because we don't give trade advice here. We don't give signals or anything like that. But how do you practice in price action? Well, you want to define price in predetermined PD arrays or points of interest, things that are salient because of liquidity and or imbalance or inefficiency. So when you incorporate time in association with one or the other, that's the only thing that can happen with price delivery outside of manual intervention, where there's a complete and utter disruption because of something that happens geopolitical or something unexpected. Okay. So years ago, we would see surprise rate announcements and whatnot, and that doesn't happen so much anymore. But the point is that type of thing can come in and unsettle the marketplace, and they'll use that immediate abrupt change in sentiment to run against the market's current sentiment. So if you've been watching the stream here, I had just the overnight Asian session buy side liquidity pool highlighted, and I'll cover why that level was important, but also what would be important for me going forward as we go into the 9:30 opening bell. So I'm going to talk to you about till 9 o'clock, and then I'm going to break, and I'm going to grab myself something to eat, and then I'll be watching the 9:30 opening bell to 10 o'clock opening range with you via Twitter or X. I'm not going to call it X, but you know what I'm talking about. So I have some old, stale PD arrays. Not that it's not good, but I'm showing you that it's old information. But because I use the frame of reference of a look back period of 20, 40, and 60 days, your highest probability, precision, high frequency setups are going to form in the last 20 days. So if you're looking back over price action for the last 20 trading days, not calendar days, you're looking at the crispest, the most precise, the most salient, the most responsive, respected PD arrays that would be in my range of interest. Now, if we get to a point where there's a whole lot of action used on them, and what do I mean by that? If we have a range that's defined as a weekly opening gap, a new week opening gap, or a new day opening gap, or a regular trading hours opening range gap, they're all different. Okay. And all those inefficiencies, if they exist, they're going to be really important for me over the last 20 days. But when I first introduced the concept, using them on your chart, because everybody understands that there's a opening gap. That's not an invention of mine. The idea of grading it, using it more than just today, or if it fills in the gap. Okay, if it closes up the gap, usually everyone else in the industry has always said, okay, well that's one and done. It's over and trash. It's no longer important, and that's a mistake. And by teaching initially, by having them on for at least 5 days, it'll help you appreciate the fact that whether they fill in or stay open, they're important. They're not just discarded simply because they traded into them or overlapped them and went the other direction. They're still useful information. because they're points of reference that the algorithm will. Oops, I'm sorry, that doesn't exist, right? It's a point of reference for price action traders to use their buying and selling pressure. Sorry, I got to stick that in there whenever I can, right? So when we're looking at days like today, where the economic calendar is kind of anemic, it doesn't really have any kind of economic drivers that would be medium impact or high impacts. It's really forcing you to look at just pure price action. And that in and of itself is not bad, but how do you engage that? Like, what do you do? What do you look for? Well, I purposely kept these old PD arrays here because they're from last week. Okay, and you can see the reference points here. This is the first presented fair value gap from January 2nd. Okay, so that's 2 Fridays ago. So it's not last Friday, but the Friday prior to it. Okay, and I have it graded. These are on the eighths. Okay, and you can see the sensitivity around all the eighths and the regular quadrants that are based on quarters, not quarterly theory. Okay, we're just measuring a range and we're dividing it into mid range, upper quadrant, lower quadrant, and high and low of the range. So it kind of like removes the ambiguity. It gives you a very specific level, and you don't have to worry about guessing what low to use to draw diagonal and supposed support and resistance on trend line stuff. Okay. Love you, Tori. No, no diss. Okay.